Hello, everyone. Thank you for joining us. We're happy to set this webinar up basically to go over some of the proposed changes to the tax planning using private corporations. They're quite significant proposed changes, and so we wanted to make sure to set this webinar up for anybody to basically get more of an understanding of what these proposals are and also what their impact's going to be. I also want to make it clear to our medical professionals as well. We do a lot of work for doctors and dentists, but I want to make sure that they understand we will be having a follow-up webinar specifically for them because there are some specific issues in that area, and we'll be contacting them at that point. Also, want to remind everybody that once we're going through this webinar, if there's any questions, please ask your questions in the chat box. We will be getting them and going through them as best as possible and trying to respond to them by sort of type of question. I'm sure there's probably going to be some similar questions overall, so we'll do our best to respond to them. So the presenters are basically myself, Chad Saikaley. I'm a tax partner, also the tax department head at GGFL, and there's also Kody Wilson, who is a tax manager with us as well. And so what's going on? Really, and why are we even having this? So as I mentioned, these proposals were released in a discussion paper, and they're the most significant proposals since 1972 in Canada. And they really touch upon many areas and affect many people. And so we wanted to make sure that again, we're going over this, but basically this was proposed in July 18 of 2017 by the Department of Finance. And they've also allowed a consultation period prior to legislation actually being passed, which is about 75 days or basically by October 2nd. And what are these proposed changes? So the proposed changes can really be looked at in four different areas. So that would be income sprinkling, lifetime capital gains exemption limitations, passive investments in a company, and surplus stripping. We'll be talking about each one. Who will be impacted? And this is pretty key because who they think will be impacted, who they're saying will be impacted, is very different from reality. They're thinking they're going after the 1%, like the George Clooney's, but in reality, they're going after the majority of Canadians, and that would be small business owners. So that would be the families of these small business owners, as well as the employees of these small business owners, because basically they're going after all private corporations. Okay, and we've got some staggering statistics that we're going to be sharing with you. And as part of our overall communication to the public and to our MPs as well, to really drive this point home. I'm going to be passing it on to Kody, who's going to be going over a scenario that we're going to be using throughout this webinar about a typical family.
Right, thanks, Chad. So we thought the best way to illustrate this was using a real-life case example of a typical family. So we have the husband and wife, Bob and Brenda, and they have 3 kids. Their age become important. There's specific rules tailored to certain age groups going forward, which we'll talk about in a second. But just keep this in mind kind of going forward. So we have Tim, who's the eldest son. He's 26, and he's fully employed, not involved in the business. We have Mark, who's at university. He's 22 right now. And then Jane, the youngest child, is 16 years of age. So the first major issue here is income sprinkling. So finance has come out and said they have an issue with income sprinkling in general. And what this really means is dividend payments to related parties. So when you have shareholders that are related, whether they're kids, their parents, their brothers and sisters, anybody in that realm, they have an issue with dividend payments going to these individuals if there's not some sort of contribution to the actual business. So think of like a salary, essentially the same kind of rules. What they want to do is make sure going forward there's some contribution in terms of labor, capital, and they're also going to look at previous returns remuneration the individuals received. They're also specifically looking at the 18 to 24 age group, and that is really what they have an issue with. The main reason being that's university students. So they have a problem with splitting income with these individuals because they're typically saying they're not involved in the business, they're not doing anything, so why are we allowing payments to these individuals on that basis? So we'll look at that pretty in depth. The second lesser issue is the impact on compound income. So right now, the first generation income is either subject to tax on split income or income at the highest rate or attribution issues. However, second generation income doesn't have the same issues. They've also said they have a problem with that. They want to tax second generation, third generation, et cetera income going forward. So that'll be something we're monitoring as well. So what does that really mean? What's the impact of having income sprinkling rules and restricting dividend payments? It means going forward, we have to look very closely at who's receiving dividends and what their contribution is to the business. So is the family actually involved in the business? Right now, we might say yes, and we don't really have a whole lot of support for it. Going forward, if the rules come in as planned right now, we're going to need significant documentation to prove to CRA in the case of an audit that yes, the family's involved, this is what they do, this is the capital contribution. So a lot more support will be needed to justify a payment in the future. Support isn't required right now for payments of dividends to shareholders. The second big issue is second generation income. We can no longer plan to use this and follow these rules because finance is attacking second generation and future income as we talked about before. And the big question this sort of leads to is what's a CRA threshold for an audit? These rules are significant, as Chad had mentioned, and really you're going to be looking at a lot of different payments over the course of the years. So what are they looking at? Is there a threshold for a dollar amount? Is it based on some other threshold they're looking at? Who's administering this? Is there a department at CRA just looking at dividend payments? We're not sure at this point. We'll see how it sort of falls out. But that's a big question right now is how they're going to administer this whole process.
Right, Kody. So we're basically going to have to consider the practicality of this.
Exactly, right. So we have another example here with our typical family. So here's a basic share structure and two different options. The first example, we have all 5 family members holding shares of the company directly. The second option is the trust holding the shares. So if these rules come in as proposed, what does this mean for income sprinkling? Well, for Bob, he's the main shareholder. He's involved in the business. It means literally nothing for him. He'll receive the same dividend with no issues, no challenges from CRA. Brenda's another issue. Right now, she's a full-time nurse and not actively involved in the business. So dividend payments to her will be restricted going forward. Is she entitled to anything? We'll have to wait and see what they say about that and see what her involvement is, if she's put capital into the business and so forth. Jane is the youngest child. She's 16. So as of right now, we're not paying a dividend anyways because the old tax on split income rules would kick in and apply. They will apply going forward the same as it did before. So there's no change to Jane. Tim is the eldest son. He's 26. So he's in this new 25 plus age group where there's still new rules, but not quite as strict as there are for 18-24 group. So again, we're looking at Tim, what his activity is in the business, if he's involved, if he's previously received dividends or salary from the company, and so forth. The biggest issue probably lies with Mark. Now, Mark is 22 years old, and he's the one subject to the substantial changes for the 18 to 24 age group. And this is where it's asking if the child is involved on a day-to-day basis in the activities. So if a university student is away and not at home, it'd be very tough to justify to CRA that yes, in fact, that shareholder, that child, was involved in the business and should warrant a dividend payment in the future. So now I'm going to pass it back to Chad to talk about the lifetime capital gains exemption limitations they're looking to impose on that front.
Thank you. So the proposal is really to, I guess, for the exemption that they're no longer going to be available for a few scenarios here. So number one, for children under the age of 18, they're also looking where the capital gain would be included in split income. So really what that is, it sort of goes back to what Kody was just talking about under income sprinkling. Basically, is the family involved in the business? If so, at what extent? So they're going to be looking into that and limiting it to depending on, I guess, the overall involvement. Also, gains that are accrued while the shares are held by a trust. So they're limiting it, no longer basically allowing an exemption to be used for, again, gains accrued by trust shares. And will also apply to share sales after 2017. However, they are allowing a one-time election in 2018. So what is this election? It basically allows for a crystallization of the capital gains exemption. And just to sort of explain what crystallization means in plain English, basically it'll allow you in 2018 to basically say, all right, how much of this gain has been accrued per individual shareholder of this company, whether or not they are involved in this company. And it allows you to then claim or elect an amount up to fair market value. And we'd have to determine what fair market value it is, but up to fair market value per shareholder, and basically hold on to and crystallize your capital gains exemption so that you're not losing it for those individuals. And then the new rules would then kick in after that point. And with this, the election would have to be done within the income tax return. There is also a normal 24-month test, which basically requires that an individual holds the shares and owns the shares for 24 months. However, for purposes of this election, they're relaxing that rule down to 12 months. And again, I want to make sure that we're clear that this unfortunately will not be available to minors. But the other thing as well is we want to make sure that we are on top of this in 2018. And again, this is if the proposals go through as stated, but we stay on top of this because there are some penalties if we elect over fair market value. So again, we want to make sure that we have proper valuation done, a proper estimate done, and also large late filing penalties. So
Yeah,
we want to stay on top of that.
exactly. And the one thing that we want to point on this slide is the penalty for electing over fair market value. If this proposal comes in as expected now, I really think CRA is going to challenge a lot of these elections. So it'll be crucial we have valuation work done on the shares to ensure we have proper valuation done and we fall into the criteria to actually use this election and don't get bumped out of it.
So what is the impact? So really what they're trying to go after is they're trying to go after people who are attempting to multiply the capital gains exemption. So it's going to be much more restrictive on that. So again, going back to this notion of the involvement of the family in the business. So is the family actually involved in the business? And if so, what documentation do you have to support that? And how involved are they? Are they just a regular sort of employee, or are they part of management? Are they making some key business decisions? So you'd want some key documentation to support that. There's also issues with trust ownership of shares of operating companies. And again, this is only for the purpose of the lifetime capital gains exemption. We'll go over other reasons why having a trust owned shares is beneficial. But for this purpose, there will be issues. There's also issues with any share ownership for minors. And again, I want to make sure that we're clear to take advantage of this one-time election in 2018. We'll be staying on top of that for each and every one of our clients and looking at it case by case. So if we break this down again with our family, so we have in 2018, if we're going to be doing this election, then we could look at crystallizing the capital gains exemption for Bob and Brenda, also Tim and Mark, because Tim and Mark are the sons that are both over 18. We would not be able to do it for Jane. So that's a scenario there that we'd be looking into. And again, we'd be looking to crystallize it for them, and mainly for Brenda, Tim, and Mark, because neither of them are actually involved in the business. Brenda is a full-time nurse, and Tim is working full-time. Also, Mark is a university student. So that's the scenario there that we'd be looking at. We also have a trust scenario where we like to use trust a lot because they're quite flexible with our planning and also quite useful for estate planning. And in a situation where there's trust, we are going to want to consider, among many other benefits, we're going to want to consider whether we have those shares allocated to the individuals in 2018 and take advantage of the selection. So I'll pass it on to Kody. I guess at this point we'll be going over the passive income or passive investments in a company.
Right, thanks, Chad. So as you can see from the previous slides in the capital gain exemption, what it really involves is a substantial amount of planning. I mean, all the sections here would be the exact same realm, but if the rules come in as proposed, we're talking about a lot of work in 17 and 18 to make sure we're properly addressing our clients' needs on a go-forward basis. So I have the unique and distinct challenge of talking about the passive investments in a company and finances proposals on that front. The reason I say that is in the documentation they've put out so far, this is the area that has the least amount of clarity to it. There's a lot of unknowns at this point, and finance doesn't seem like they're totally sure how they actually want to attack it. What we do know is they have an issue with what's happening right now. And to put it very simply, they have an issue with the investment base for somebody with a corporation being substantially higher than an unincorporated employee. So we think about someone in the highest tax bracket. The unincorporated employee pays 53% tax and can invest the remainder. If the individual is incorporated, they have a business, it's much better because what happens is they're paying tax at the low rate, the small business rate, or they're paying the general rate. Either way, those rates, which are 26.5 and 15 respectively, are both better than the highest personal rate. So your base to invest with is bigger at the corporate level as opposed to taking it personally. And they've looked at this and said they have an issue with it. What they haven't considered, we'll talk later in the slides, is the amount of risk and other issues that are associated with running a business, and they're discounting those factors greatly. But as of right now, that at a holistic level is what they're looking to do and what they're looking to attack. And essentially, all these rules we're posing are for corporate level capital, which you've paid tax at the corporate rates on. So if you're paying those low corporate tax rates and you're investing that income, that's what they have a problem with, the investment income generated thereon. So they've put in a number of comments and talked about what they see as issues and what they kind of want to correct going forward. Again, I want to really make sure it's clear that they haven't really made it, clear on their end to say what they want to do. They know the issues they have, and they've suggested general methods that might accomplish these goals, but they're very unsure at this point in time. And it's also worth noting there's draft legislation out on the first two sections Chad and I talked about. There's no draft legislation on any of this stuff at this point, given the uncertainty involved with it. So what they're looking at doing, a couple examples, is looking at refundable tax. So right now, if you're investing in a corporation, you pay investment tax rate, a large portion of which is refundable when you ultimately pay a dividend to your shareholders. So it's a temporary tax. They're saying we want to re-examine this and we want to make that refundable tax unrefundable. So that entire 50.17 we're paying now, there's no refundable portion going forward. That's a permanent tax you're paying on any investment earnings. So the issue with that is when the amount comes out of the corporation, which would be as a dividend to the shareholders, they're still taxing it in the person's hands at the same tax rate. So what you can see essentially is double taxes happening. You're paying a higher corporate rate and you're paying the personal rate. And they're really trying to punish the person for investing at the corporate level. They're also saying they're going to look at CDA additions. So right now we have a capital dividend account for our companies. If we have a capital gain on the sale of a capital asset, half that amount's taxable and half goes to the CDA pool, which can be extracted tax-free by the shareholder. They want to eliminate any additions to the CDA pool if that CDA addition would have stemmed from capital taxed at the corporate rate. And then they're also looking at eligible dividends and the treatment of those. So if you invest and get a dividend from Apple, it comes and it's eligible because it's from a public company, and it loses the classification when you pay it to your shareholders. What that ultimately means is you're paying more tax at the personal level because of the classification of the dividend. So again, they're punishing shareholders for investing in public companies, and public companies might see a hit from this if we can no longer invest at the corporate level. So continuing on that same realm, they have some more issues they want to talk about too. The big one they want to say is intercorporate dividends right now, we can get those tax-free potentially if certain parts of the act are met. Going forward, they want to remove that ability. So if you're paying a dividend from an operating company to a holding company or somebody else in that corporate group and not paying personal tax, they want to impose another piece of refundable tax on that payment. So instead of the treatment now where we can move money around between corporations and avoid paying any kind of tax other than the set corporate rate, we'd be paying the corporate rate plus we'd be paying this refundable tax. So again, the same issue where our investment base is significantly eroded if this rule comes in as proposed. That being said, it is on a go-forward basis, as are most of the rules discussed in this presentation. So it's talking about typically 2018 going forward. So the current investment base you have is safe. So if you build significant capital up in a holding company at this point or an operating company, that's safe from the new rules, and you're still under the old regime. And obviously, as the rules sort of explain, there's no impact to with companies with no passive income. That's all we're asking is that passive income piece essentially. So what they've said now too, quite generally, is there's two methods they're looking at for the ultimate dividend payment to shareholders. So once that capital is coming out to the shareholder, whoever it may be in the family group, they're looking at ways they can tax that, which again are essentially punishing the shareholder for investing their after-tax capital at the corporate level. Don't want to spend a whole lot of time on these two methods because they've even said in their submission that they're not really sure which of these methods will stick if either of them stick. It might be something totally new. It might be they abandon this altogether. So quite generally, I'll tell you what they're looking at doing though. The apportionment method, we have three pools of capital they're going to track each year. One is low rate, and one is high rate, and one is capital from shareholders. What they're then looking to do is to allocate the investment income earned each year to each of these pools based on the weighting. So as you can see, this gets quite convoluted and is going to add a lot of compliance costs and headaches to small businesses when finance in their last budget specifically stated they want to lower compliance and decrease the burden on these people. And now these methods are both significantly going against that. The other method is the elective method. So under this option, your default treatment assumes that all your low corporate capital is the capital that's invested. So what does that mean? That means essentially that when you get a dividend, it's ineligible. So it's at a higher rate personally when you pay tax on it. As the name implies, there is an election. The election basically is saying we can say that all our passive income generated is actually from our high rate pool, which gives us eligible dividends from our GRIP pool. But the big issue with this is there ultimate loss of the small business deduction at the corporate level. So we're stuck paying the high rate of the corporation. It's unclear at this point if they're looking to do a year-by-year election or if they're looking to do a one-time election you can't opt out of later on. We'll sort of monitor as it comes up and see what they go with, if it's either of these options at all. But that generally is their suggestions they have now, and they're looking for the public to help them with ways to correct this. So those are the general changes for passive income. What does that mean going forward? Beneficiaries, corporate beneficiaries of a trust, the benefit's limited going forward. There still is a great benefit to using these, but a big part of the tax benefit is being eliminated if these rules come in as proposed. Income splitting, we're limited there, obviously. The good news, again, current passive capital, that's grandfathered. So we're okay on that front. And then a pure investment holdco is still okay. So we still have the old regime for refundable taxes, capital dividends, eligible dividend treatment. So on that front, we're still okay. They're just attacking the low corporate rate capital that's being invested. And what they're doing here, they want a high dividend tax rate when you're pulling the money out, which makes up the difference. So you're paying a high rate of personal tax and dividend plus this high corporate rate, again, double taxation we've talked about before. However, even if these rules come in as proposed, there might still be an advantage to going through this if you can pay a dividend to the shareholder when they're in a lower tax bracket, which the obvious example would be retirement, and then maybe there's still benefit to going through this exercise. So we put a quick example together here to show you what this really means. And you'll see it says second generation at the top. So what that means is we've paid our corporate tax on the earnings, and we're now investing this capital in, let's say it's a bond, and we'll call the income interest income. So on the left-hand side, we have the current regime. We have income, we're saying it's interest of $100. We have corporate investment tax, which in Ontario is 50.17, which we pay on that income. If we're paying a dividend in the same year, we get a dividend refund of $30.67. So what that means is the net corporate tax on that investment is $19.50. So from the $100, we pay our $19.50 of corporate tax, and then we pay a dividend to our shareholder. Leaves us with $80.50. The personal tax at the highest rate in Ontario, 45.33%, gives us $36.49. So our after-tax cash for investing $100 in a bond instrument at the corporate level is $44.01 in our hands personally end of the day. Again, assuming top rates. The proposed regime is similar. So your income is the same amount and your tax is the same. The big difference, as you can see, is the dividend refund, which is a refundable tax. That portion will no longer exist. Because that doesn't exist, the amount at the corporate level is significantly reduced to 50.17. Because that amount's reduced so greatly, we're now looking at a significantly lower dividend of $49.83 and then personal tax of $22.59. So it leaves us with $27.24 of after-tax cash in comparison to $44.01 of the current regime. So quickly you can see there's a significant disadvantage going forward to investing any capital and earning any investment income on it.
Yeah, that's 73%. And I just want to make sure that people that are looking at this and thinking, how can that be? How can they actually tax 73%? I just want to make sure that we're clear on what they're trying to go after. And really what it is they're basically saying, they want to treat it as though you earned the income in the corporation, then paid it all out to you personally and paid the high rate of tax on this. And again, this isn't exact or perfect in any manner, but they're sort of assuming that you're paying the high rate of tax and then from a much lower base using that remaining capital to invest and then earn the income. So really it's a complex exercise for them to try to figure out, what would this have been had you taken the money out personally. So that's what that really means. A couple things though is, and Kody already alluded to this, but this is the one proposal of the four that we believe has the lowest probability of being passed as is, just because there's so much uncertainty, so much so that they can't even draft the legislation around it. So keep that in mind. The other thing too is, they're looking within this proposal to tax intercorporate dividends. This is something that they tried doing almost 2 years ago, and it turned out that, I guess there was quite a bit of an uproar from private businesses, and they ended up leaving it as is. So again, they tried doing this before. There were reasons why they didn't go ahead with it, and those reasons still exist. So just want to keep that in mind. And
yeah, great point. And again, this is all an investment income generated. So maybe the comment now leads us, if these rules come as proposed, which we're hoping they expecting they maybe won't, is maybe we invest in assets that don't generate income. So if we invest in real estate, which gives us to a break-even point, or other assets similar, where we're getting a return of capital, picture a REIT or similar investment, or we're not generating income, maybe that's the path we go with going forward if that's the case.
Yeah, or even a corporate-owned insurance policy, life insurance policy.
Right.
So, all right.
So I'll flip back to Chad now. He'll talk quickly about the surplus stripping and what that means going forward.
Thanks, Kody. So with surplus stripping, this is the one area I'm not going to be talking a lot about this area because it's let's say this. There's actually a part of this where they're actually strengthening their position, and then there's another part where they're potentially softening, which is really good. And the part that they're looking to sort of strengthen is an area that we tend not to want to take advantage of anyway because they tend to be quite abusive. But really, what finance is looking to do is they're trying to eliminate the ability of shareholders to convert salary and dividends into capital gains, which are taxed less or not taxed at all if they're able to use the capital gains exemption. So really, the new rules would enhance, I guess, existing legislation to cast a wider net. But where they may be softening, I guess one of the issues that we've always had with this area is for intergenerational transfers. So that would be, for example, succession planning in a family business, and it was quite prohibitive for certain I guess planning to be done within that. Whereas what finance has done is they've sort of come out and acknowledged that there is an unintended treatment for genuine intergenerational transfers, and so they're looking into ways to actually resolve it. But there still are some issues for I guess one of the planning things or planning options that we try to take advantage of is upon the death of an individual and trying to avoid double taxation. So these current rules, these proposed rules, I should say, basically add some further complexity to that. So what are the possible concerns overall with these proposed changes? So these proposed changes overlook a number of things that we want to communicate clearly to the public and to MPs. They overlook the fact that there is quite a bit of risk in the first place of actually operating a small business. There's also a lack of pension, lack of job security, health insurance, or any other group benefits. There's a lack of paid vacation, severance, maternity leave, et cetera, et cetera. So the impact that these proposed changes would have on small businesses and their employees, and I want to make sure that we clarify, also their employees potentially, will be profound. And so what are possible planning points for 2017? And first thing I'll say is it's important that we don't have any knee-jerk reactions because at this point, again, they're proposed and there may be some watering down by the time they actually get passed. And we will have some time before the end of the year. But a few things that we can do in 2017 is consider, and this is case by case, but consider a payment of a large dividend or large dividends to family members by the end of the year. We also want to consider potentially paying a salary to justify future dividends if we're going to be going down that route in the future. We want to consider allocating or having the trust allocate shares that it owns of your companies to the individuals directly. And at the same time, basically hand in hand, planning for this one-time 2018 election. There's also some ideas that we have as well for less active related shareholders in the company. So they would be, for example, your adult child who is, let's say, over the age of 25, or let's say a spouse as well. And some of the things that we can look into potentially is doing somewhat of a freeze of their current value. So basically saying, whatever their current shareholdings worth, then we'll freeze that and then redeem it over time, which sort of acts like a dividend, but does not seem to get caught under these proposed rules yet. But there's a few things that we're looking into. And again, we will be looking at this on a case-by-case basis and communicating that for you.
Yeah, exactly. These are some ideas we've had initially based on the changes as they're proposed right now. They may change drastically from what they're listed as. And as they do, we'll update our planning accordingly as we go forward. This is just some general ideas at this point in time based on the current draft legislation.
Right. So really, you want to look at your current structure because everybody's pretty different. You want to look at it and say, what is or was the purpose of the structure? Really, was it for income sprinkling, wealth transfer, creditor protection, estate planning? And there's many other reasons why we may have put your plan to have you in a certain structure, and you want to consider that. For example, I have some clients that really cared more for creditor protection and estate planning than anything else. And so they won't be impacted as much. Whereas others were really getting into the structure mainly for income sprinkling. And then obviously now they're at risk. So we want to consider and clearly consider what the main reason was. And then also, if we're just losing income sprinkling, but then also having the creditor protection as well as a number of other estate planning benefits, again, we want to look at it from a case by case and speak to you about that and what would be the best next steps. And a few questions to also consider is, first of all, what is the involvement of family members in your business? Because if they're already quite involved and they're part of management, they're part of the key business decisions that are being made, then you're not really going to be impacted much by this when it comes to the income sprinkling, when it comes to the multiplication of the capital gains exemption. So you want to consider that. The other thing then too is there even an ability to use the capital gains exemption on the sale? Does your company even meet the criteria? And is it for the current or future, let's say capital gains or growth? So you want to consider that. But then even if it does apply, the question is, what is your expected gain? So for example, let's say we have a husband and wife both running a company. Between the two of them, assuming they haven't claimed the exemption in the past, they could shelter approximately $1.7 million of a capital gain. So do you expect your gain to be much more than that? If not, then again, that part of the proposed rules will not really impact that scenario. So again, we want to look at this and break this down. And who will be impacted? I'll let Kody take it over from here.
Yeah, thanks, Chad. So, I mean, the quick answer here is everybody. And we wanted to highlight a couple stats for you, the first 2 points, which you can sort of read on your own there. What we're really saying is small business in Canada is so pervasive, it affects everybody. They're not attacking the wealthy business owners. What they're doing is impacting the growth and innovation in Canada on a go-forward basis, and how much those businesses can grow, how much they can hire, future ventures they can consider. It's really going to stagnate growth, in our opinion, on a go-forward basis if any of these rules come in. So you can see from the first 2 points, small business is extremely pervasive. And what they're kind of saying is, we think that there's a tax advantage to these people right now, and we want to attack it. And they've really ignored all of the benefits that these individuals provide to the economy. And they're ignoring the fact that if they keep going through with these rules, they're going to stagnate growth, and people might invest less in the business. People might close the business altogether. I've had some clients call and ask, what's the point to taking this risk on now if they're going to tax me like this anyways? So there's a lot of things to consider, which we think they've ignored. And last point just talks the fact about if they come in, what does this mean for us? Are we laying off employees at certain companies because they can't just afford it anymore? Is there less working hours? Are we lowering salaries? Are we drawing back on benefits, pensions, health insurance, everything else? There's a lot of issues to consider that we think they've overlooked, and they've strictly looked at what they look as a tax advantage being received and ignoring the benefit that's provided for the risk that these people take on.
Right. So what is GGFL doing? I can tell you we're getting quite active with this. So we're not just sitting back and waiting for finance to come out with their final proposed changes to go through. Really, we're working with DFK Canada. That's one of the things that we're doing. And DFK Canada is basically our national association of affiliated accounting firms. And what we're doing is looking to educate the public, but mainly as well MPs across Canada. We want to make sure that they understand what the true impact is. I've had some really interesting conversations with some MPs lately, and they don't actually fully understand what this real impact is. And I'm talking about Liberal MPs that you would think would have been made aware of this before the discussion paper was released. And one of them in particular was getting really upset with the Liberals continuously using the term or phrase 1%, top 1%. And this is a Liberal MP himself saying that he realizes that's not the case. So we're really working with DFK Canada to do this. We're also going to be releasing more information to give you more background knowledge on these rules. You're going to be getting it shortly, I would say within the next few days or by next week maximum at the latest. But the main thing is communicating this. I also had an OPED of mine posted on the Ottawa Citizen website last week, I believe it was last Friday, going over some of this and really trying to drive that message home that it's affecting not just the top 1%, but it's also affecting small businesses, private, so it's private businesses in general, as well as implications to their employees. So again, one of the things that we want to be clear with you on is, no knee-jerk reactions. We are proactively going to be contacting each and every one of our clients with a tailored plan as we get more clarity. And what can you do? So really, the only thing that we strongly suggest you do is speak to your local MP and really express your concerns. And the main thing is, I want to make sure that you are clear about how these would impact your business, but also your employees. I want them to realize, we should make sure that they realize as much as possible that it's not just this smaller percentage, but there's a trickling effect as well with your employees. For example, are you going to be cutting back on group insurance plans? Are you going to be laying anybody off? There's going to be a number of potential implications that I want to make sure you clarify with your MPs. And I guess at this point, we'll open this up to questions. There have been a few questions that have sort of trickled in throughout our webinar that we've sort of gone through and we've sort of, I guess, put together. So give us a bit of time and we'll go through it. And again, obviously, if there's other questions, please proceed and put them through our chat box. But one of the questions was, what is the extent of investment required? So I guess this question is more on, tax on split income as well. So what that question, if I could sort of break that down, is if there's a husband and wife who each contribute $100 to start up the capital, and then each invest $10,000 while the wife is not involved at all in the business, so what is the implication on that? I guess one of the things to consider is the rules that they have where they break it down by age category. So you've got less or minors, you've got the 18 to 24, and then you've got the 25 and above. So in this particular case, it would obviously be the 25 and above. There is not much in terms of solid guidance being given other than being reasonable. So for example, they're a lot more strict when it comes to the age category of 18 to 24, where they basically say that they'd want to see a reasonable rate of return on that investment. So they look at potentially $10,000, and then the reasonable rate of return may be the prescribed rate by the CRA, which is 1%. However, for the age category of 25 and above, they're not really applying the same stringent rules. It's more of, again, this notion of reasonable. Kody, I don't know if you want to expand on that.
Yeah, no, I think that's a good answer. I mean, there's a lot of uncertainty right now, A, over how they're going to administer this entire process, and B, what exactly they're looking at. They might say it's a combination of a labor contribution, an additional capital contribution, and what's happened in the past. So if we're at a point now where the new rules come in and the non-active shareholder just plows some money into the corporation, are they entitled to a dividend above and beyond a prescribed rate? We don't know the answer right now, but it's obviously we're going to monitor and check in as things come up.
Right. There's another question of, is there anything that GGFL can provide you to show your concern to your local MP? I think if you check out the OPED in the Ottawa Citizen, that's going to break down a lot of this information. But really, I think for the message to be driven home, it would be best if it's sort of tailored to, again, to your specific situation. So if you're employing, if you have a number of employees, try to think about what you might need to do and where you may need to cut back a bit. But also, if it's not the employees, if it's again, it's just you and you're running this business for your family, and you're looking at this as being your business, your driver for your pension, for your future pension. Talk about how that may be impacted, how that could be impacted. And because really at the end of the day, if you look at a government employee, they're able to invest for the most part with pre-tax dollars towards their pension. And we have, for example, an RRSP, but it's nothing like the pensions of these larger corporations. So talk about some points about that. But really, I think if you check out our op-ed in the Ottawa Citizen, that should help. And we'll be again sending out more information. And we'll actually send a link. Yeah, I'm speaking to one of our admin people here, and we're going to be sending out a link to that op-ed to everybody on this webinar.
Sorry, so one more question just came through here, and it's a good one. So if you have either a child now between 18 and 24, or a non-active spouse potentially a business, or somebody else related, the question is, should I pay a maximum dividend in 2017? Great point. We're thinking along the same lines. Um, the comment here has a certain date to do it before, and it's October 2nd. You're not limited by the October 2nd date. October 2nd is just the date that finance is taking submission papers to what they put forth so far. So we're not limited by October 2nd. If anything, it'll be a calendar year basis. So we should have end of December 31st to make any dividend payments we wish. So we advise our clients right now. We talk with your advisor here at GGFL. We're not doing anything right now. We're strictly talking about potential scenarios if the rules come as proposed. We're not going to do anything until they come into effect. And if it's the case where the income splitting comes in as it's proposed right now, then a maximum dividend probably makes sense. And we do that in late 2017, most likely.
All right, we have another good question here. Does that mean trusts are now not as useful anymore? And, it's a good question. So really, these proposals are just going after taxes. All right, so they're proposed tax changes and not going after trusts. So there still are a number of benefits and reasons why you'd want to have a trust as well, and want to continue to have a trust. And just a few of them, for example, is for estate planning, overall estate planning. So do you really want to be issuing specific shares to, everyone in your family at this point? Do you want to do it now, or do you want to have control over how that happens? And you can't really be issuing shares directly to a minor in the first place anyway. So there's some benefits there. There's also the fact of creditor protection as well. Trusts are a great tool to separate legal ownership from beneficial ownership. So those are just a couple of many different reasons why. And so we'd be speaking with you individually as to whether or not you should continue to use your trust, and if so, how.
Yeah, exactly. So, I mean, what Chad's saying is your trust useless? I mean, absolutely not. There's a guarantee still benefit there, but we work on a case by case basis to say, does it make sense in your situation still going forward? Some of the tax benefits are slightly muted now if the rules come in, but we still have an advantage there and a lot of good things that a trust can accomplish for a family unit.
Right. And all right, for time constraints, I guess we're just taking one more. And I guess this question is, will real estate investments held in a corporation be affected? So this sort of touches upon something that Kody mentioned before about looking at what sort of investments you could have in your corporation, and what types of income they would have. So really, real estate investments, yes, they're considered passive for the most part, unless you have a certain amount of employees running this, but they're considered passive, and so as such they would be effective. But then again, you want to look at the facts of the case. So for the most part, real estate investments, we could claim CCA or amortization, which is like depreciation that sort of offsets a lot of the income. And so you tend to not see real estate investments be that sort of taxable or have that much taxable income. So yes, but again, you want to sort of consider the extent of that.
Yeah, that's good. And I think we want to also reinforce the point that these are rules on a go forward basis. So if the pool of capital is from corporately invested earnings, but you have real estate investments to this point, you're not impacted by the new rules. So real estate investments you have currently, there's no impact. It's
Right.
Still very beneficial.
And if you have a holding company, by the way, a holding company that has basically passive investments, if that's all that it has been doing and that's all that it's going to continue to do, then it won't be impacted by these rules. They're not trying to go after that. But what they're trying to go after is if you do have a holding company that holds investments and you're trying to fund it more through a corporate vehicle. So basically use, a dividend from one corporation to the other, which currently is tax free. They're looking at ways to somehow attack that. And I think that's it. So thank you all for joining us. And we're going to be posting this on our website as well. Everybody will have communication to let them know of when this is posted. and we will be in touch with you.
Yeah, thank you.